My name's Owen. It's nice to see everybody today. I always love coming to this conference. I don't like presenting, to be honest with you, but I'm a member of Smallcap Discoveries, and so for me, this conference is kind of like being in your seat. I get to meet with the CEOs that I've invested in. I own a little bit of Name Silo and Reno Works. I own Hash. I rode that one all the way up and all the way down. So it's you too, eh? Yeah. Okay. Right on. But anyways, I appreciate you coming, and I look forward to presenting. This is a deck that covers our results up until Q2 of this year. We posted those results in August. And I look forward to presenting and walking through this. If you have questions, don't wait for the Q&A period. Just feel free to hit me up. So we track stuff. We're a company that provides asset tracking devices. We design and manufacture the hardware. And I'll show you some of those devices as we get through the presentation. And then we have software for our clients to log into the web and view the location of their assets, view the utilization reports on their assets, their trip reports, and basically provide our clients an ROI by understanding the environmental conditions and the operating conditions of what those assets are going through. We track a lot of different types of assets, and we have different products that are suited towards those different types of assets. But we track everything from pallets to bike share bikes with lift. We track porta potties. There's actually a lot of money in porta potties, believe it or not. And the really interesting thing is, as the price points of these trackers and the monthly services come down, and that's really been our shtick, is to disrupt the market from a price perspective. You can start tracking assets that are less and less valuable. If you have a device that's sub $50 and monthly fees coming down to $1 a month, it starts to make sense to track an asset like a pallet. Maybe not a wood pallet, but a plastic pallet, a reusable or returnable pallet. And wood pallets when there's an expensive asset on top of it. So it's a massive industry. It's the IoT industry. If you look at the market size of IoT, you're, strong growth rates, averaging about 20 to 30% growth in that range. When you look at the subset of the IoT market, the asset tracking market or the trailer, cargo container, these are subsets of the the overall market. They're also expected to grow, and so there's a handful of subsets that we really focus on and have done quite well in. We've sold over almost 450,000 devices in the last 6 years, 6 or 7 years. We launched it about 7 years ago, I guess. We sell through the carriers. We sell through distribution partners. We don't have a large sales and marketing team. We don't do a lot of conferences. We support, the likes of Bell, who's also an investor in the company, AT&T, T-Mobile, and they bring it to market. They invest in the sales and marketing, and we invest in the technology to make sure they're successful. This is kind of interesting. This is our sort of historic device sales on a year-over-year basis. We launched our cellular devices back in 2018, and the interesting thing about this chart is this actually matches every time we bring out a new piece of hardware or do a broad refresh on devices across the board. So launched the initial product in 2018, did a revision between 2020 and 2021 and saw an upgrade. We increased functionality, we improved reliability, those types of things. And then again in 2023, came out with our version 4 and our B Mini product, which I'll show you in a second. And then, the result, that's the good and the bad about technology, right? You gotta keep investing. You gotta keep bringing out new product every year to 2 years to keep that growth going. This year, we plan to bring out 3 new products over the next 9 months. One of them coming out imminently, one of them coming out in December. It's called the Batman. It's not called the Batman. That's what I call it. It looks like a Batman. The thing about this is we're even driving price points even lower. Cost to produce this is about 30 to 35 bucks. We're gonna make more dollar margin on this product than we did the product that it's gonna replace. And this one had about, $45 to $50 BOM cost. So keep driving. That's the point in technology. Keep bringing out new product. Sometimes that product is to, we're engineering price out of it. Sometimes we're putting functionality into it. And sometimes both at the same time, making it cheaper and better. We typically sell, on average, about 25,000 units a quarter, 100,000 units a year. The most recent quarter, Q2, was our second highest. Quite a bit lower than our highest, which was Q3 of last year. We sold 20,000 units to UPS in this quarter. So we had an outlier that really spiked it. Outside of that, this was a record quarter for us in Q2. Very simple business model. We sell hardware, we collect the revenue off the hardware, and we charge a monthly fee. Monthly fee is anywhere between $1 and $3 a month, depending on the level of service that we're offering. Hardware, we don't sell hardware for more than $100, depending on the SKU. Anywhere from $50 to $100, but with new product, we're going to be driving that price point lower. Maybe I'll just take a second to talk about it. Recurring revenue. Every device that goes out the door has a monthly, fee that goes along with it. Last quarter, it was about 36% recurring. The quarter before that, we had a weaker hardware quarter. We were navigating tariffs. We were working through renegotiating with our distributors. And recurring revenue was over 50%. So, a higher percentage of recurring revenue in a given quarter isn't always a good thing. It means that your hardware sales were lower. But obviously, recurring revenue is a key for us. Investors focus on recurring revenue. Some investors only value us on our recurring revenue. They don't give us any credit for the hardware, not even one times. They just look at recurring. What's your recurring doing quarter over quarter over quarter? Service revenue represents installation revenue. It can represent development charges. So UPS, we had about 30 or 40 grand US in development charges from them. Not this quarter, but a previous quarter. Roadmap, R&D, constantly focused on bringing out new product, enhancing the software, leveraging machine learning where we can, leveraging AI where we can. We actually don't really promote ourselves as a machine learning and AI company. We promote ourselves as a machine learning and AI enabler. So the data that we provide to Costco and UPS is run through their machine learning algorithms to give them better insights into what their assets are going through. J.B. Hunt's another example. We monitor their pallet lifts, their electric power lifts. We provide them the power level and the voltage of that power lift, how much battery is left. They run that through an algorithm that optimizes when and where to charge those electric pallet lifts to keep their lifespan as long as possible. Companies that are doing hardware and software are coming back into flavor. For the longest, we see Constellation, right? Constellation took a huge hit, and they took a hit because their AI strategy isn't articulated properly. It's not that it's not articulated. Constellation Software has been buying software companies. The guys that are enabling machine learning and AI, the hardware companies, whether it's, SMC Micro, whether it's the chip guys, or whether it's guys like us generating data and feeding those algorithms, feeding those machine learning algorithms to be able to provide those insights. So I think you're going to see hardware come back into flavor. It's been out of flavor for a while. I said we don't get any credit for our hardware. But I think things are starting to swing back a little bit. From the very beginning, we've been hardware and software. We do everything. With a small team, we design the hardware, we write the firmware for the devices, we create the middleware, and we develop the applications that our clients use. So with a relatively small team, we bite off a fair chunk of it. I'm going to have to hurry along a little bit. We have two types of distributors. Some distributors that just sell our stuff off the shelf, more of a commodity-based business. Price point, is the key there. And then we have some partners and distributors and end users where we're actively engaged in product development. The likes of UPS, Brinks, Garda, Tenna, Loomis, Lyft, all had some custom development. AT&T, Bell, T-Mobile, they're taking a standard product and just rinse and repeat. Right? That's where price point's important. It's a commodity when you're just selling the same thing over and over again. So it's a tiered marketing strategy. It's not a pyramid. We sell to AT&T, They put it on their paper, they sell to their end users. They charge them a monthly, we charge them a monthly. They mark everything up. They mark the hardware up, they mark the monthly up. But for a relatively small company, quite a roster of big clients. Home Depot, Canadian Tire up here, Home Depot in the US, Lowe's, Costco, Ford, UPS, Fortune 500, Fortune 100 companies. I have a slide that I'm going to kind of try and jump to quickly that I think reiterates why we like getting into the Fortune 100 and Fortune 500 clients. Here's the slide here. If we look at our past, what this slide is showing is we start with these large enterprise clients, usually with a relatively small demo. Anywhere between 100 and 1,000 units could be an early stage demo. We don't actually see expansion in these clients until we've actually run through that demo, showed them the ROI, engaged with them. And then it's year 2 and year 3, right? UPS, it's not a short sales cycle. This represents a lot of work, a lot of blood and sweat, but they pay off. But the point of this slide is, for the first 6 years, we only engaged with 5 or so Fortune 100, Fortune 500, large enterprise clients. Within the last year, we've taken on 5 additional large enterprise clients that we're just starting the early stage with. All you need is a couple of those to pop. And we saw that with our results with Q3 last year with UPS, right? It can have a big impact on your numbers when you pull in a 20 or 30,000 unit deal, especially when you're averaging like 25,000 units a quarter. So we're encouraged about our ability to get into these large accounts through our distribution and then work them and see them to fruition. I can actually add United Airlines to that. I don't know if United's Fortune 500, but another big one with a large opportunity. They just put an order in for 100 units just this morning. The potential in those 5 that we're just starting with represents over 325,000. Yes, sir. Yeah. It's a big orange bar for all of them. Yeah. Are you able to satisfy this? Yeah. So I actually have a slide. Let me see if I can jump to it quickly. Really has to do with tariffs. I'm going to bounce around a little bit here. So we historically, we own the IP, right? We design everything. We've been making the PCBA in China historically. We had to change that process from having product from China going into the US. Now we bring it into Canada. We load firmware on it. That allows us to be USMCA compliant. We just got our USMCA compliancy in September. Literally, our first orders under USMCA are going out now. But as we went through that process, we realized that USMCA, as we know it today, isn't going to be around for very long. So we currently represent about 10% of the business for our Chinese contract manufacturer. We just lit up another one in Albania. The reason we chose Albania is because their effective tariff rate is 10%. So if USMCA goes back up, which everybody thinks it's going to go up, right? It's not going to go down. It can't go below 0. We've now positioned ourselves to have a maximum tariff rate of 10%. But these are kind of mid-sized contract manufacturers. And mid-sized contract manufacturer in China is like the largest in Canada. So that's kind of what we're dealing with. I'm going to back it up a little bit. I skipped a bunch of slides there. Kind of bouncing all over the place now. Okay. One of the products that we've had a lot of success with, this is a variant of a product, is a solution we sell with AT&T. It's a network, it's a cellular network called FirstNet. FirstNet is a cellular network that guarantees prioritized service for first responders. So in the middle of a disaster, congestion hits the network. This guarantees that first responders will get data or get their phone calls through. We've created our product, developed firmware, certified it with FirstNet so that they sell our products into first responders in the US. That culminated with an order about 2 weeks ago for 8,000 units. It represents over 100 first responders, Boston Fire, state of Florida emergency management, over 100 of these types of agencies right across the board. Outside of that, we were already working. We had already sold over 3,000 units, including, Denver Water, Alabama DOT, North Carolina DOT, and a lot of government-related business. My previous company was in telematics and did all government. I swore I would never sell into government again. The sales cycle can be brutal, and here we are selling into government again. Although we're not selling, AT&T is selling. Continuing, along that theme in New York, we got an RFP out of New York City from DCAS, which is the procurement department in New York City, back in 2019, for a small implementation at the time with parks. We've since grown it. We now have FDNY. We do parks, New York Housing Authority, New York Department of Education. Continues to expand. Another example, get in early, show them an ROI, and keep working the account until you can make it something more significant. Very experienced management team. We've, with the exception of Margot actually came from Bay Street, came from the investor side. The rest of us have all been in vehicle telematics since the late 90s. Transitioned into asset tracking, which is sort of a subset of telematics. This is the thing that gives me the most confidence. When we are addressing, it doesn't matter what we're addressing. If it's tariffs, if it's COVID, if it's the financial crisis, if it's the dot-com bubble blowing up, these guys have been through every one. And they'll get us through the next. Revenue increased about 30% year over year, every year, since 2018. We closed out 2024 at about $17.5 million in revenue.
What percentage of your revenue is recurring revenue?
It depends on the quarter, Vic. I think I had the number up there last quarter. It was in the mid-30s. Here. So almost $7 million in recurring revenue on 17.5 for last year. But that can vary, right? When you have a weak hardware quarter, your recurring is a higher percentage. Let me just see. So revenue continues to go up, recurring revenue continues to go up. We have started to get some seasonal clients. UPS is a seasonal client. We're tracking the equipment that they bring in for peak season. Peak season for UPS is Q4 and Q1. That's, Christmas and Boxing Day sales. Positive EBITDA for the last 4 years. Fairly straight trend. Total revenue broken down quarterly. We're continuing to show, strong growth. But this quarter, we dealt with tariffs. And I'll show you what I mean by that. But we're getting through it. We're going to, just like we got through other issues. But, 5.5 million, it was over 10% higher than our previous record high. And if we looked at that year over year, it was just under 30% revenue growth on the quarter, year over year. There's our recurring revenue. This was actually predicted. Like I said, a drop in recurring was the result of that seasonal contract with UPS. It was big, right? 20,000 units, generating $2 US per month in Q4 and Q1, and then dropping off in Q2 and Q3. Yes, sir.
What's your margins on recurring revenue?
Margin on recurring revenue, there's two forms. We do have some legacy recurring revenue that's lower margin. That's when we're reselling Geotab into our armored clients. Margin on these products that we're talking about on the recurring revenue is very high. It's about 90%. When you mix it, it's about 60%. Margin on the hardware is much lower. Went even lower with the tariffs, right? We ate part of the tariffs. Trump's wrong. It's not like, the companies are eating the whole thing, but we ate half of it. Our clients ate the other half. In the most recent quarter, the tariffs cost our little company $425,000, over $500,000 if we go back to the beginning of the year. And that's why it was so important to get our USMCA compliance, to change our processes, to get rid of that tax that we've been seeing, but also to make sure when USMCA goes back up that we have a plan with Albania to keep it at the smallest level possible. Yes, sir.
Yeah, I think for the annual recurring, fiscal 21 was lower than 20. So what happened in that year?
Where are you looking? Oh, here. There? Yeah, okay. I mentioned lower margin on some of that historic recurring revenue. This is what we do for the armored car guys. We do have software that we provide to them. That software resides on top of Geotab. And so we don't make the same margin. We only make about anywhere between 15 and 20% margin. What happened here was that Brinks, we lost the resale portion of that contract with Brinks. So we didn't lose our margin. You know, our $2 a month we kept making, it didn't hit our bottom line, but we did lose the resale portion. They didn't like the vendor that they brought it to. They gave it back to us. And we were actually reluctant to take it. We didn't want the pass-through revenue back. But it was the best for them. It really was important for them that they had a vendor that was experienced with their business. Sometimes they do that. You know, you bring in a new fleet manager, they have a history working with other vendors, and you know, there's a movement to have that pass-through business move to somebody else. In this case, it didn't work for Brinks, and they brought it back to us. So that's a long explanation of why you saw the drop and then the backup. Yes, sir.
Owen, can you give us an update on the satellite situation that you mentioned?
Yeah, let me go back here. We've had a change of gears on our, so there's, I mean, a lot of people have heard about direct-to-device for satellite, right? Your iPhones and your Android devices being able to send a text message out over satellite when you're no longer in coverage. That uses a technology that actually is specific to the module. You need a very specific module in the device that does both cellular and satellite. This was the route that we were going originally. And as we've worked through that technology with our mobile network operators, AT&T and Bell, they have directed us towards a company called AST Space Mobile. AST Space Mobile trades on the NASDAQ. They do less revenue than us, and they have about an $8 billion market cap. They have a satellite that literally opens up an antenna array that is the size of a tennis court. And it allows every single phone, whether it's a 3G phone or a 4G phone or our device, to communicate over satellite without any additional technology in that device, entirely backwards compatible. The reason it works that way is the antenna is the size of a tennis court. You know, most satellite antennas are like this. This antenna folds out. It's a really interesting company. I mean, I mentioned they do less revenue than us, and they have a $7 or $8 billion market cap. The reason they have that is Bell has invested big. AT&T has invested big. Verizon, Vodafone. One of our board members is the head of R&D for Vodafone. He also sits on the board of AST. When Vodafone made their investment, they positioned him on the board. And so we're excited about it, but we have to be a little patient. It's probably coming, they're starting to launch their network of satellites imminently. They have about 5 or 6 birds in the sky. They have to fill out a constellation of 30. And then once that's filled out, you know, their whole model is they'll turn on the tap once the constellation, and the revenue will start flowing in, right? That's why they're getting this crazy valuation. You know.
What percentage of your revenue comes from that?
It's a good question. It does open up additional markets, right? It opens up ocean-going containers, ocean-going freight, ocean-going boats. It opens up fisheries. So that's how we look at it. Does it give us the opportunity to get into additional markets? And the answer is yes. We moved away from the 5G NTN stuff because it wasn't strategic for our distributors, right? We're not going to push a product that they don't want to push. They've invested in AST. They believe in it. They've done their due diligence. We have to follow their suit. So it's coming. It's just not quite as quick as I would have liked. Oh boy. Yeah, positive EBITDA, decent revenue growth. Not always like record quarter over quarter. I'll be disappointed if we don't hit a record this quarter though. We're seeing strong demand. We continue to see strong demand. But because we have a good chunk that's hardware, it's not, you know, you get a little bit of lumpy. just depending on what comes in on a given quarter. Talked a little bit about the seasonality with UPS. We will get that UPS revenue back in for Q4 and for Q1. The interesting thing about that contract is we showed them a 15% efficiency gain. They were renting 15% more pieces of equipment than they needed to get through peak season. And so you think you show a client a good ROI, you get a pat on the back. We get 15% less assets to track the next year. So we actually get a 15% reduction in recurring revenue. But we showed them a strong ROI, and there's more opportunities in UPS. UPS has one of the largest trailer fleets in North America that we'd love to get our hands on. Adjusted EBITDA, this is the Trump effect. $425,000 hit. This would have been, oh boy, this would have been almost over $750,000 in EBITDA without the hit. That's why it was so important for us to get through USMCA. Talked a little bit about that. I won't go into that. This is an interesting chart. Any guess what this was? 2023. Our stock was at 20 cents literally for the previous 4 years. This was small cap discovery in 2023. We didn't do any marketing. We stopped investing in IR. We didn't do any promotion. We took that budget and moved it into an issuer bid. Still haven't invested in IR. I'm working on it myself. Sofix are good, if you're looking for IR, those are the guys that I'd go with. I will go with. We're getting there. High growth, industry with a massive market potential. We continue to disrupt it from a price point, continue to get our share of the market. Strong distribution, AT&T, Bell, T-Mobile, some of the top technology companies in our space carry our product and distribute it. Decent balance sheet, haven't raised money in over 6 years. We're reluctant to raise money, we don't like to dilute. And that's because we have strong ownership, right? We're aligned with shareholders. 22% of the company is owned by me and the co-founder. I have some slides on, I left these for the back in case there were any questions. These are contracts that we've promoted over the last few years. They continue to remain strong clients. They continue to buy more product. But we do a lot of bike share with Lyft. I think we're over 12,000 units sold to Lyft in their bike share program. They're one of the largest bike share providers. Everybody thinks of Lyft as food and auto share, but they're one of the largest bike share. Costco, over 11,000 units, continues to expand, continue to bring us new projects. I think we're probably 4+ years into that relationship. UPS, another one that continues to expand, although we had a 15% reduction this year. But plenty of opportunities within different departments within these large enterprise clients. That's it, guys. Right on time.